Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a fantastic discussion lined up. We're fortunate to have with us Eric Young returning to the show. He owns and operates a company that contracts out manufacturing to Chinese factories on behalf of global retail companies and chains. He's based in Hong Kong. He's been analyzing the gold market since 2009. He shares his expert analysis of the gold and silver market on X. Today we're going to do a deep dive into the gold flows from the LBMA to the COMEX, why the system was built the way it was, and how and why it's now appearing to unravel, and more. Eric, welcome back to Metals and Miners. Thanks so much for joining us today.
Thank you, Gary. Thank you for having me on again. Sure.
All right, so let's start with why the system was built the way it was. The COMEX, the LBMA, why did they set up the system in the fashion that they did?
So, Gary, the Western gold and silver system, trading system consists of the LBMA, the COMEX, and the ETFs. And these entities are all tied together by a system called the EFPs, which don't let the name deceive you. It's called the exchange for physical, but a lot of the times it's just, cash settlements. So that's how the Western gold and silver system is set up. Now, shall we first tell your audience what each of these entities do so that they have a general idea?
Yeah, please.
Yeah, okay. So the COMEX, as you probably know, is just a futures exchange. It is regulated by the CFTC and the US government. So it's a real exchange, and it has to abide to US laws. And what it does is it allows buyers and sellers to buy and sell futures contracts, which essentially you're either buying production or commodities, gold and silver, for the current month or future months. So that's simple enough, right? The LBMA, on the other hand, is a private OTC market. So it's not an exchange. It's simply a over-the-counter marketplace for a buyer and seller to negotiate with each other and have private transactions. Now, we all know how the COMEX pricing works. It's electronic, it's real-time. It's because it's a futures exchange. But that's not how the pricing at the LBMA works. The LBMA, since is an OTC market, it has these, what they call price fixes, LBMA price fixes. Every day, 10:30 a.m. and 3 p.m. in the afternoon, they do price fixes for gold and silver. So 2 times a day they do that. So these are what they call the LBMA benchmark prices. They fix these prices so that their members can reference these prices to do the transactions at the OTC market at the LBMA. So as you can see, because these are private transactions, and these buyers and sellers at the LBMA are simply referencing these prices, we don't truly know what the real price is that they transact. And by the way, we all know what a futures contract is at the COMEX. At the LBMA, industry experts call their contracts promissory notes. What they mean by that is that it's simply a paper promissory of physical gold and silver. Doesn't mean you'll get it in time, as we shall see in this program. I'm going to explain that, what's happening recently. But they are simply promissory paper notes. And you can also have forward contracts. So that's similar to futures contract, but it's not. It's just a promissory note for a delivery in the future. Futures contract. They call it the spot contracts and all these forward contracts. They call them cash contracts, essentially, which is a contract with a delivery date stipulated in the contract. So now we have defined what the COMEX is and what the LBMA is. Let's talk about EFP. What is a EFP, right? Everybody talks about EFP, exchange for physical. Like I said, Gary, don't let the name deceive you. Exchange for physical is simply one of its functions. So what does the EFP do? The EFP is a conduit that buyers and sellers at the COMEX can settle their contracts outside of COMEX. They record the transaction after they finish the EFP settlement, but essentially it's a outside of COMEX transaction. That's what the EFP is. It allows, let's say, a short seller at the COMEX to buy physical metal at the LBMA and have it delivered to the COMEX. That's one function. Or it allows a LBMA contract holder to have physical metal bought from the futures contract at the COMEX and delivered to the LBMA. So it's just like the conduit that allows physical metal to go back and forth between the two exchanges. And it also, you can also have a EFP with the ETFs like GLD and SLV. You can get physical metal from GLD and SLV, and via EFP, exchange for physical, you can ship that physical metal to the COMEX or the LBMA. So again,
so Eric, there's been a lot of chatter and many theories as what's happening right now as to the massive amount of gold that's moving from the LBMA over to the COMEX. What is happening right now with gold and even silver here that's forcing or driving all of this gold over?
Okay. So I just want to finish that EFP explanation. So it's a conduit that allows physical gold or silver to move from exchange to OTC or OTC to exchange, or from the ETFs to both the OTC or the exchange. But in the past, guess what, Gary? A lot of this were cash settled. 95% or above of the EFPs were actually cash settlements. So no physical gold and silver moved in the past. So what's happening right now? Why is it that the LBMA seems to be breaking down? What I mean by that is their physical gold delivery went from T+2 to T+60 or T+90. That was reported by Reuters back at the end of January. What's happening? And we also hear that the US is importing a lot of gold, and the COMEX is importing a lot of gold. The US imported, 2,000 plus metric tons between the end of December to the middle of February. So 2.5 months.
And as we were
2,000 plus metric tons.
And as we were talking off camera, that is about 25% roughly of the total reported gold holdings that the United States has.
Yes. Okay. Correct. So yes, so the U.S. is importing a lot of gold. The COMEX imported back in the middle of February. It was reported from COMEX data, by the way, 700 plus metric tons of gold. And I believe it's around 900 now, because the COMEX vows increased 200 metric tons between that time and now. So let's just say 900 approximately. That's a lot, Gary. 900 is almost 10% of US official gold holdings.
More than 10%.
More than 10%. So give you an idea, normally how much gold does US import every year? Around 350 tons a year. So it did 900 tons. No, not 3 times, Gary. Some people calculated this to be 15 times. Because that 350 tons, they did it in a year, entire year. Now they're doing 900 in 3 months. Think about that.
Yeah, it's amazing.
Right? So that's a lot, right? So why, the question, going back to your original question, all this, how does it all tie in? What's happening? Why is the US demand for gold? Why is it affecting the LBMA? And what is the end result? What's going on? So, like I said, the EFPs are simply arrangements outside or contracts outside of the COMEX and LBMA. It's an off-exchange contract. So what generally happened, Gary, is that a lot of bullion banks, they would have concentrated short positions in COMEX, a lot of it, for gold and silver. I mean, this is very well documented by industry experts like Ted Butler and Jim Sinclair. They talked about it for years. But when they talked about it in the past, the bankers came out and said, well, yeah, these are concentrated shorts, but they're not naked shorts. Because these huge short positions at the COMEX, they are hedged by the EFP pair at the LBMA. So what the bullion banks would do, they would short the COMEX, but they would long an equivalent weight of the gold and silver at the LBMA. So they made money by skimming the system, by the arbitrage. As long as the price of the gold or silver at the COMEX is lower than the price of the gold or silver at the LBMA, they made money. You see that, right, Gary? It's just an arbitrage. They made money.
And the only way to stop that, as we were discussing off camera, is the call for the physical.
Correct. Because let me explain to you what's happening when they call for the physical. So all of a sudden, you have a whole bunch of big buyers at the COMEX, and they say, we no longer want to cash settle. Because all that concentrated shorts at the COMEX in the past, and their corresponding longs at the LBMA, that EFP basis trade pair, that's what we call it. That's what experts call it. Most of those were cash settled in the past. But all of a sudden, like you said, a lot of people, a lot of big entities are saying, we don't want to cash settle. We want the physical gold. That's a big change. And silver. So silver is being squeezed right now too. But let's talk about gold. So what happened when that happened? Well, when that happened, it drained the LBMA gold supply through the mechanism that we just explained, the EFP mechanism, right? When it drained the gold supply at the LBMA, and at the same time, it also bidded up the price of gold and silver at the COMEX. So what happened? What happened after that? Well, if you're bidding up the price of gold and silver at the COMEX because of the huge demand for physical, all of a sudden, your EFP trading pair, your arbitrage, is losing money because your COMEX contract is more expensive than your promissory note at the LBMA. So it's it reversed, right? That reversed. They were losing money, right? So if you are a bullion bank, you're losing money. You normally have, let's say, you're able to be matched up with buyers that are willing to cash settle, but your paper contract, your spread is negative. You're losing money. What are you compelled to do, Gary? You're compelled to stand for physical delivery at the LBMA because your paper contract is cheaper now. It dropped in price, but your physical gold is still whatever, 1,000 ounces, never changed. So you stand for delivery for the gold and you deliver to the COMEX. So it's a vicious, what I call an EFP doom loop, because it feeds on to itself. It encourages more people, more bullion banks to go to the LBMA and stand for physical gold and silver delivery. Okay, so that's how it that doom loop keep going on, and it drained the LBMA of any gold that it would have. So right now, the LBMA delivery time, like I said, reported to be T plus 60 or T plus 90. Now, Gary, the LBMA's latest numbers, they claim that they have 8,477 tons of physical gold at the vaults. Do you believe that number? If they tell you that they have that 8,477 is a lot of gold tons. That's more than the US Treasury gold, right? 8,133 tons. They're telling you they have that much gold, but they can't deliver T plus 2. What does that mean? That means the free floating gold is zero. Big fat zero. The 8,477 tons are gold that are allocated to other people that they cannot touch. The free floating gold is zero. The delivery time is T plus 30, T plus 60, T plus 90. We don't know what the situation is right now exactly, but based on the report from Reuters, that's what we're looking at.
So, Eric, there's
Yes.
a lot of people are wondering, how do you know all of this information? And here's something I want you to just briefly touch on with folks. And you're an independent. You're not working for a major company in the industry. You're not working for the COMEX or the LBMA. You're not working for the government. You're not involved. You're independent, trying to share independent information, and in so doing, you have people who are coming to you from the industry. Instead of going to others who could expose them, they're coming to you, and they're basically helping you understand the bigger picture that's taking place. Am I right?
You're right, Gary, because like you said, there might be bigger names out there than me, but they are all connected in the gold and silver industry. So a lot of these actual bankers who have a job in the system right now, they are essentially whistleblowers. They don't like what they see. What I mean is the LBMA is blowing up. They don't like what they see. They see a lot of wrongs in the system. They see that this whole Western gold and silver system is not working. The suppression is not working. So they want to tell someone, and I'm the prime candidate for that because I'm not affiliated with anybody. I'm not going to expose my sources. I'm not going to get them fired. So they have taught me a lot, actually, in the last 2 months about the system.
Yeah,
a lot of the information that I'm sharing with you are from industry insiders. And as a matter of fact, you saw that post or tweet I made on Twitter today about I was explaining how the EFP mechanism works. And somebody came on my thread. He said he worked at the COMEX for 20 years in the 1980s to the 2000s. And he said that everything that I wrote about EFPs are 100% correct.
Yeah, that's exactly what he wrote.
So there you are, right? Like I get a lot of people coming to me. So
well, that's great. So you're becoming a repository of information from insider sources, and so you're now helping everybody else in the space kind of understand to see what's happening. So let's go to the next step. You've laid out, the LBMA, the COMEX, what's happening there. Who is, there's been a massive amount of gold. You just expressed it, 15 to 25% of the U.S. total holdings have come flooding into the system over back to the country in like 3 months or less. Who, in your opinion, Eric, is buying or bringing all of this gold over to take delivery, and for what purpose? What is happening here?
So Gary, this is all just from, like I have to make a disclaimer here, right? It's all just educated deduction, like Sherlock Holmes deduction, based on evidence that we see. I mean, if I know everything for fact, I would be Warren Buffett, or I would be like Jerome Powell.
Well,
But
King Kong
what we do,
King Kong Holmes. King Kong
yes,
Holmes.
King Kong Holmes. That's right. So
That's
this
the
is
new name.
a deduction, right? So let's look at the evidence. 2,000 metric tons plus of physical gold within 2.5 months. Guess what? US trade data only recorded approximately the gold that we talked about that the COMEX imported. So this 2,000 plus number is not from just this guy off the street. The 2,000 plus metric tons of gold that the US imported is from Mnt&x and Bullion Vault. They are both LBMA members, and Mnt&x is actually a LBMA gold and silver AM PM price fix participant. So these are high-level companies that are involved in the gold and silver business. So that 2,000 metric tons imports number, that's for real, in my opinion. But let's go back to the story. So the US trade data doesn't show the extra 1,300 tons. What wouldn't show in the US trade data, Gary? Monetary gold is exempt from that. Monetary gold is exempt from that. What is monetary gold? Monetary gold is basically the gold that the Federal Reserve would store for the US Treasury. That's monetary gold. You don't need to report that. Okay, so that's one evidence. I believe, by the way, I believe that whoever is importing all this gold in such a short period of time, they are either US government, the Fed, or their proxies. Okay, that's my original thesis. But I actually think it's the bullion banks doing it right now. The bullion banks, the US bullion banks are importing a lot of gold on behalf of the Federal Reserve and the US government. And I'll explain why I say that. So that's the first piece of evidence that shows that it might be monetary gold, it might be the US government, Fed proxies, which are the bullion banks. Second piece of evidence. Why do I say that? What happened to the Hunt brothers, Gary, when they tried to corner the silver market and they bought up all the silver? What happened?
The government.
They got shut down, right?
Yeah.
Right? They got shut down. Why are they not shutting down whoever is buying all that gold and silver right now? Like what they did to the Hunt brothers. I mean, it's causing a lot of chaos, right? It's almost like I said it in another interview. It's almost like a public execution of the LBMA. LBMA is part of the US empire. Why would they, if it's just a nobody, why would they allow them to do that? So it's a special entity, right?
Fair.
Probably the US government or like Fed or the proxies. What's the third piece of evidence that is more empirical that we see? All this gold and silver flooding into the COMEX eligible vaults. That's where they land. It's the eligible vaults. And a lot of people are taking delivery, for sure. Your audience can search online and find the numbers. Delivery, all it means is that at the COMEX, all it means is that you issued a warrant. It's a piece of paper. Doesn't mean that you will withdraw it from the COMEX vote. So delivery and withdrawal are different. Delivery means you get a piece of paper. It's called warrant. Withdraw is you actually take that warrant and you take the physical metal out of the COMEX vault. So guess what's happening, Gary? A lot of people are taking delivery. Delivery, but they're not necessarily withdrawing, especially for gold. For silver, there's a lot of withdrawal. As I see when I was doing my research. But for gold, a lot of these entities are leaving it at the COMEX register vault. So what happened in the past when that happened? When a surge of metals come in and people take delivery, but then they keep the metal in the register vault. What happened, Gary, is that a lot of those metals get recirculated into the COMEX system. Because you hold the piece of paper, the warrant, you can lease or sell that. You can't lease it because it has to be ineligible for you to be able to lease it. But you can sell that warrant to a buyer in the COMEX system. Does that make any sense, Gary?
Absolutely. So
in the past, that's how the price crashed, right? Because or part of the reason, because a lot of these people, they have the warrant now, but they want to make a buck. So they see the price go up, they sell the warrant, they make the money. But right now, with the continuous imports of gold and silver from London, continuous, it's not stopping. It looks like that the warrant holders right now, that piece of paper with the warrant, whoever is holding that warrant, they're not letting that metal recycle into the COMEX. If you're just a nobody, just a guy like let's say a hedge fund or a family office, you wouldn't hold on to that many warrants. You would just sell it for profit.
Okay, so you've laid out why very clearly why you believe it's the government or the proxies. So
yes,
I'm assuming, Eric, that you're tying this to the chatter that we're hearing by the current Trump administration of wanting to audit the gold holdings and not wanting to have egg on their face for having, let's say, 4,000 or 5,000 or 6,000 metric tons showing up instead of the 8,133.
Yes. I just want to address one more thing, Gary, because a lot of experts are saying this is because of tariffs. Remember? They're still saying that. Financial Times put out an article, I think last week, saying that it's because of the tariffs. Right. And that makes sense. Like back in February, okay, fine, right? Because Donald Trump did not slap the tariffs on Canada and Mexico yet. So that makes sense. By the way, Canada and Mexico combined imported around 250 metric tons of gold into the US. Actually, less than that, sorry. It's less than 200 metric tons of gold in 2023. So my numbers may be incorrect, but it's not a lot. Okay, it's below 200. Now, like I said, the US is importing 2,000 plus metric tons within 3 months. So does it make any sense to you that if it's tariffs, the US would import 10 times the amounts that they normally would from Canada and Mexico? It doesn't make any sense. So that's number one. Number two is more empirical evidence that I wrote on my Twitter account, and no expert can deny that I'm correct. Gold and silver exempt from the tariffs, the Trump tariffs. So explain to me, why is it that gold and silver imports into the US is still so large right now, even with Donald Trump exempting gold and silver from the tariff? So I think the tariff thing doesn't make any sense. It made sense as an accelerator before Trump enacted the tariffs, but now it just doesn't make any sense at all whatsoever. So now we get on to your actual question. You asked me why is the US importing all this gold. Do you follow Judy Shelton, Gary?
Yeah. Yes. Yes.
Yeah,
Yes.
she is a lady who was the nominee for a voting Fed as a nominee. She was the nominee of Donald Trump to become a voting Fed member during Donald Trump's first term.
Mm-hmm.
And it looks like that Donald Trump is potentially going to nominate her to be the next Fed chairperson in 2026. So what is Judy saying? Judy's saying that the US is potentially going to, number one, audit all US gold, 8,133 metric tons, not just Fort Knox, all of it. Step one. Step two, the US is going to revalue the 8,133 tons of physical gold. To what? Mark to market. So nothing crazy, nothing like, Gary, some experts I really respect, say that it will be revalued to 20,000, 100,000. That's not what Judy's saying. Judy's saying it's going to be valued mark to market. What that means is that let's say gold is at $4,000 in 2026 when she gets into office, they're going to revalue it to $4,000.
And
Market price.
what's the benefit to them to do that?
The benefit is that, like, versus, let's say they revalue it to 200,000. The benefit is that. Yes.
What's the benefit to revaluing it at all?
At all? Okay, that's the third step. The third step that Judy said is that the US is going to utilize the 8,133 metric tons of gold to issue US Treasury Gold Bonds to fix long duration US Treasury bonds. Because if you recall, Gary, that's the number one concern of Scott Bessent, is to fix long duration. Why do they want to fix long duration? Right now, the US national debt is sitting at $36.5 trillion. They added $1.5 trillion in less than 5 months. It's crazy. It's like a hockey stick. It's going geometric. And short duration issuance of US Treasury bonds is sitting at 55% of all new US Treasury issuance. There's actual numbers, Gary, from 2024. 55%. So a lot of people say, okay, who cares? Short duration, long duration, who cares? Let me give you an example. Let's say you buy a house, and every year you got to redo your mortgage. But before you redo your mortgage, you need to pay your principal and all the interest every single year for your $1 million house. That's going to be a freaking nightmare, Gary. It's way better if you have a 50-year mortgage and you spread out your principal and your interest 50 years, right? That's why the US government want long duration to make up the majority of the debt, not short duration. Okay, I don't think a lot of experts explain this because they think this is too simple of a concept and that people should understand it. But a lot of people get confused. That's why I'm saying it today. So now you understand why the US government wants to issue more long duration bonds. But the problem is nobody trusts the US government. The BRICS Plus guys, yeah, they're buying US treasuries, but they're mainly buying the T-bills, the 1 year, the 2 year, whatever. Why? Look at Russia. You buy 30-year, 50-year bonds, the US Treasury can just push a button and cancel you. Freeze your asset. What are you going to do? Who are you going to cry to? They'll just say, oh, you violated some human rights or whatever. You are a war criminal, whatever, so we're going to cancel. We're going to freeze. Well, they might not cancel you immediately. They freeze first, right? They freeze your US long duration. So everybody, most of these BRICS global South countries, they want T-bills. They want the short duration stuff. And then even the US allies, I mean, they're not stupid. They look at that hockey stick debt. They think, well, if I'm holding this thing for 50 years,
What's
I
it
mean,
gonna
I'm
be worth?
screwed, right? I'm
Yeah.
screwed in 50 years, right? Like, so I love the short duration because that's just US dollar, basically US dollar cash with a yield attached to it. Why not? Tell you the truth, Gary, I own some US T-bills because, like, through my bank, right? Not like a direct T-bill, but you know what I mean, structured product, right?
Yeah.
Because it's nice, it's short, I get the high interest. Why not? Everybody loves it. Nobody want to hold the long stuff though. You crazy? 50 years? What's going to happen in 50 years? So Judy is proposing this thing, this US Treasury Gold Bond, to fix that. Now,
Her time
an
frame, I
interesting thing,
believe, is
yeah,
is by July 4th.
2026, July 4th, 2026. So they got a tight schedule here, right?
So
That's
there's a lot
like,
of things that you're expecting some significant fireworks to
oh
take place
yeah,
between
oh
now
yeah,
and then.
oh yeah,
Yeah.
oh yeah, Gary. And think about this. One thing that she said that I initially thought, why, is she said these US Treasury Gold Bonds with zero yield, zero coupon. You don't get any coupons. So people ask me, and they ask Judy too, why do anybody want to buy that? Even if it's like, let's say, backed by gold. You buy it at the point when you buy it, let's say it's 1,000 tons of gold, or let's say 100 tons. More believable, of a small sovereign, 100 tons. And when you sell it in 50 years, they give you back 100 tons. That's all fine. I make money with the gold appreciation in US dollar terms, right? But I can just buy gold. Why do I want to buy that? Why do I want to buy that US Treasury gold bond? Well, number one is the US Treasury gold bond is probably a better collateral than the physical gold in the American empire system, right? Because it's a US Treasury bond. I don't think any of the milkshake guys will disagree with me on that, right? Because it's a it's within the US Treasury system. Number two, have you heard of this gentleman called Jim Bianco from Bianco Research?
Oh yeah.
Oh yeah, okay. So he did an interview with Macro Voices, and he said he have information from BC that tells him that Donald Trump and Bessent, they're going to try something. What are they going to try? To reduce the debt or the interest payments to the debt. Because they're paying what, Gary? They're paying $1 trillion a year just to service the $36.5 trillion of national debt.
And growing.
And growing. 1 trillion, let's put that into context. That's more, $200 billion more than the US defense budget. The US defense budget is $800 billion. That's crazy.
Yeah.
So Bessent, his number one concern is the long end of the US Treasury market. Second concern is to reduce that interest payment. So what's the plan that they have cooking up? They're going to try to force US allies to convert the existing US Treasury bonds. Let's say these US allies are holding a whole bunch of bonds, different duration, for 2% coupon, 2% yield. They want to force the US allies to convert that into a zero coupon century bond. 50 year or 100 years. Originally, I think Jim said 100 years, and I said, hey, Jim, nobody's going to go for that. And then Jim said, yeah, maybe it's going to go for 50 years, right? So 50-year zero coupon bond. But guess what? If it's zero coupon 50 years, you're going to get killed if it's fiat, right? On the principal.
Exactly.
So it makes sense. You put Jim Bianco and Judy Shelton together, it all makes sense now, right? Now you have a zero coupon physical gold bond that you're forcing your US allies to buy. That's a captured audience. What we call a captured audience. Why do I say that? If they don't convert it or they don't buy it, US Army, US military is going to say bye-bye. You're going to have to defend yourself against the Russians or whoever. That's it, my friend. That's
so they're
the plan.
basically going to force them into those gold bonds.
That's exactly it.
Yeah.
So this whole thing that they're doing is for that purpose, is to reduce US interest payments on debt from that 1 trillion and growing to a manageable level, and also to make long duration US Treasury bonds more attractive.
So Eric,
Makes total sense.
yeah, I mean, you've laid it
Yeah.
out. You've laid it out wonderfully. Some are believing the situation is ripe for an epic slam back down to 2,500 or even further.
Yes.
What's your perspective on that?
I have a good perspective, Gary. That's a wonderful question. So if you look at the COMEX inventory charts, you can pull that up later. COMEX vault inventory chart for gold. What happened when it got slammed last time? In 2021, the end of 2021, beginning of 2022. The gold flows reversed, my friend. That gold that is coming into COMEX vaults, it reversed. A lot, like people, some experts reminded me, some of that gold can be withdrawn to private entities. Yeah, sure. But a lot of it reversed back to London. So the thing to watch for is this London situation. If the gold reverse back to London, we might get a snap. But if the gold doesn't reverse back to London, and it keeps, I mean, it's increasing the flow to the US, how is it going to crash? Because the COMEX, that's indicative that the COMEX has a lot of demand for physical gold. Remember what I said? If the COMEX has a lot of demand, multiples of normal, it will start this EFP doom loop. Therefore, it will propel the price of gold up, not down. Now, we talked about the doom loop. The doom loop is actually just the draining part. It's draining the LBMA gold. But what if, let's say, there's no LBMA gold, or most gold spoken for? What happens at the COMEX? Short covering, Gary. Short covering. That means your bullion bank who's holding these short contracts at the LBMA for the gold, they have to buy an equivalent long contract at the LBMA at the COMEX to cover for that short. What does that mean? That simply means you're robbing Peter to pay Paul at the COMEX. That's a classic short squeeze. Mike Maloney talked about that 2 days ago. We are at that stage. That's why, my friend, went hockey stick on Friday. You asked me that before we recorded. What happened? That's what happened. Not enough gold. So they exhausted that doom loop, whatever thing, right, from the LBMA, getting gold there. And now some entities are short covering at the COMEX. And the gold price is going up.
And
so the only way I see that reverse is if they somehow temporarily resolve the gold supply issue. Physical, I mean. But I don't see that. Because right now they're tapping into central banks gold. Like this is reported by Bloomberg. Bloomberg is saying that the LBMA members are actually borrowing gold from foreign central banks. So you might ask me, why are these foreign central banks so stupid? Everybody can see what me and you can see, right? With the gold situation, with the lack of supply, why are these foreign central banks willing to let LBMA members borrow physical gold? Well, Gary, it's because a lot of these foreign central banks, like Argentina, they are beholden to the IMF or Western banks. So they have a whole bunch of gold. What is happening? What is happening is the IMF or their central bank buddies, or their Western commercial banks buddies, they're calling up these foreign central banks and they say, if you don't lease us your gold, or let us borrow your gold to deliver to the US, we're going to call your US dollar loan. You owe us $10 billion, let's pay up. So these foreign central banks are compelled to give up their gold. to give up their gold. And one last question. I know you didn't ask me this, but we talked about this off camera. And you asked me, where is the US government? If it's the US government and their proxies, where are they getting the money to buy all this gold? Because the US government is broke, right? They're borrowing money right now at an accelerated rate. Where is that money to buy all this gold? Well, Gary, you know how the US Treasury gold is structured right now? The US Treasury don't actually have the 8,133 tons. The Federal Reserve is the custodian of that gold. So it's only on paper that the US Treasury have the 8,133 tons. The physical custodian is the Federal Reserve. And supposedly the gold is held in deep storage at Fort Knox, Denver, the Federal Reserve Vaults in New York, and West Point. So 4 locations, supposedly. But over the years, a lot of experts have reported, like Ron Amani, and recently George Fair from Scottsdale Mint, his research team, have reported that over the years, the Federal Reserve's member banks, which are the usual suspects, JP Morgan, Morgan Stanley, Citibank, etc. You know what, Bank of America, right? Apparently, those guys have been leasing out US government gold. So some of it has been leased out. Let's say around 2,000-3,000 tons. That's my deduction, by the way. It's not a fact. It's just based on what I'm seeing here. What George Fair's team and Ron and Manny talk about. It looks like they leased it out. So now that the US government want to order this gold, what's happening? It's telling the Fed, hey, where's the gold? It has to be in these vaults. So the Fed is calling its member banks to repatriate US Treasury gold back into the US.
Yeah, and
Therefore,
if there was an audit and they were, 2,000-3,000 metric tons short, it wouldn't just be egg on the face. The American public would lose their mind.
Yeah, exactly. But like what I'm trying to say is that it's costing the US government no additional money. Yeah. Because it's just calling back is the gold that is theirs, right? Like
and
I
they're
mean, it's
leveraging
the custodian that loaned it out.
They're leveraging their military, they're leveraging the IMF and the loans that are out there. They're leveraging, they're compelling, but this is the mechanism. This is what's taking place. So one last thing that we talked about off camera that we didn't talk about so far, and that is once they mark to market the gold, what do you see happening to the price of gold? Does it stay in that range, or do you expect it to float a lot higher?
Okay. So, like I said, the U.S. government is utilizing the gold as essentially a collateral. The U.S. government will not sell the gold. It's ridiculous. I know some people, some false experts are saying that the U.S. government will sell the gold. No. It's going to be used as a form of collateral, just like what Judy Shelton is saying. Because remember, the brilliance of that gold bond is 50 years. So the US government don't even need to produce, present that physical gold for 50 years. Think about that. Isn't that a great deal, Gary? All of a sudden you have a bunch of money in your balance sheet and you don't need to hand over the gold for 50 years. That's a great deal for the US government. Not so much for the allies, but for the US government, it's a great deal. So back to your question, what will happen after the revaluation happens? I think the gold price will go up. Why do I say that? Because let's go back to the example we used, the house that you bought for $1 million. You bought your house for $1 million, and let's say it appreciated to $2 million, like just by market forces. So that's kind of like the revaluation. I'm just using that as an analogy to what the U.S. government is doing. So it appreciated from $1 to $2 million. So all of a sudden you have a whole bunch of new equity, right? Because the U.S. government, by the way, before revaluation, on the U.S. Treasury balance sheet, the statutory value is only 42.22 US dollars. So they're revaluing it from 42.22 to whatever, 3,500. It's a lot of money. It's almost $1 trillion. I saw somebody calculated something like that. So the U.S. government is using that as a collateral. Back to our house example. So you're using the house as a collateral at $2 million. So you're using that as a piggy bank. Everybody knows. You go back to the bank, you second mortgage it. You're pumping money off that. What happens if a 2008 situation happens and your house goes down back to $1 million? You're screwed, right? Your asset is suddenly a negative asset. It's negative equity. So the US government would not want the gold to be below that mark-to-market value after it revalues it. So my prediction is that whatever that revaluation is, let's say $3,500, that's the new floor for the US dollar gold price.
It
makes sense, right?
Yeah,
it makes sense, right? So and then it'll give the market a huge confidence, right? Huge confidence, because the US government is essentially remonetizing physical gold. So I think it's once that happens, gold is going to go up pretty fast, in my opinion.
All right. Yeah. Well, hey, everyone, welcome to this fantastic interview with Eric Young, precious metals expert. This has been an amazing discussion. And before we wrap up here, we ask our final set of questions for Eric. I just want to direct everyone interested in the metals and mining sector and investments just to dive into our Substack at metalsandminers.substack.com. Join the community, receive a free report titled "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. Consider upgrading while you're there for access to premium content. All premium content provides a comprehensive analysis of global trends, asset sentiment, and deep dives on individual miners for more informed decision making. And even without premium, though, there's plenty of free content daily. So just go over, visit metalsandminers.substack.com to join us and explore. And really, thank you again for watching this video interview with Eric. Now, I'm positive that you've enjoyed this conversation with Eric as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. Eric, let's just finish off our fantastic discussion that we're having with something that I call a lightning round. I'm going to ask you to rank a few assets as a buy or a sell by giving it a score of 1 to 100, with 100 being an extreme buy, 1 being an extreme sell. Just give 1 or 2 sentences, be real brief, as to why you take that position. If it's an asset that you're not following, that's okay. All right?
Okay. So 10 is extreme buy and 1 is extreme sell.
Let's go 1 to 100. Okay.
1 to 100. Okay.
Yeah, with 100 being an extreme buy.
Buy. Yeah.
So on a scale of 1 to 100, is gold a buy or a sell right now, and why?
I would say 90 because of the reasons I just explained. I think the US government is at the cusp of physical gold revaluation.
Okay. 1 to 100, gold miners, are they a buy or sell, and why?
I would say probably 90 in this juncture because they're so cheap, Gary. I mean, so disconnected with the some of them with the gold prices. So many deals out there. So I think I know I didn't say 90 last time, but it looks like it's a 90 this time.
Okay. 1 to 100 is silver, a buy or a sell, and why?
Again, it's 90, Gary, because $34 right now? Is it 34? I think it closed. It's a joke. It's a joke. Yeah. I mean, the 1980 high is 50. So,
right.
Yeah, it's a joke. Yeah.
Okay. 1 to 100 silver miners.
It's a 90, Gary, because some of these silver miners are so cheap. It's unbelievable right now. Yep.
Copper.
Copper, I give it an 80 just because I think the US might actually be in a recession very soon.
Okay.
Industrial, right? So
yeah, industrial.
Uranium?
Yeah, uranium.
Uranium, I think maybe 80. I like uranium. I own a lot of uranium miners, but I think, like I said, the US is probably going to a recession. But uranium, I think within the next 3 years is going to go up a lot. Why do I say that? Because the US is reshoring industries, and it needs a very strong uranium industry domestically.
Do you like uranium miners more than the uranium metal? Do you like them the same?
I can't keep uranium metal in my house, right? I got radioactive
Well, you
poison.
could buy it. You could buy the proxy. Is what I. You're hilarious.
I buy the Sprout uranium trust. So I own a lot of it. I like it. I like it. I
You
own
like both?
Sprout. I like both, yeah, but I own more miners and slightly less Sprout Uranium Trust, and it proved that my decision was correct because the Sprout Uranium Trust went down way more than the miners in the
Okay.
last 3 months. Yeah,
All right. 1 to 100 is oil, a buyer or selling. Why?
I think oil 70 because of the upcoming recession that I think the US is going to be in, and uh, and I think the US is going to be pumping a lot of oil very soon under Donald Trump.
Yeah, and I
Yeah.
also heard that they're planning on trying to work with OPEC to get them to release some of the reserves that they've been holding back.
Correct. So think about it, Gary. If oil prices go down, but gold and silver price go up, what will happen to the miners? Your energy input is lower, your and your products is going higher. Is
What a
going to be
what a wonderful setup.
that's exactly it, Gary. Yes.
Yeah. All right, 1 to 100 for the Nasdaq.
Oh man, this is 50, my friend. 50. Almost failing. I think I think AI is a wonderful thing. I use it a lot. I mean, I can't live without AI. I tell you, I'll be honest. I can't live without it. It saves me a lot of money and a lot of time. But I think the prices of these Max 7 companies and these US tech companies are way overvalued. And I think they will correct. So 50. Yes.
All right, what about the S&P 500?
Probably 60, slightly better than the Nasdaq, but I think it'll correct because they
Okay.
overshot. Yeah,
Okay. We talked about treasuries a little bit earlier. For the short term side, you were a lot more positive than on the long term
correct.
side. So on the short term side, 1 to 100, what would you give it?
I give it 80 because I hold it myself to collect. I mean, US Treasury T-bills are basically my fixed income asset.
Okay.
I need it. So so I hold that just like all the other central banks that we discussed. They hold
Okay.
T-bills. But yeah, so
But
I
then
give it 80.
for the
Yeah.
long term treasuries,
Oh, I give that 20, my friend. I mean, nobody in their right mind should buy 10 years and above US Treasuries. It's insane. Given the choice, yeah,
yeah.
20, definitely.
Okay.
Yeah.
All right. And finally, on a scale of just 1 to 10, with each representing a percentage like 1%, 2%, or even 2.5%, and you can give a range if you like, where do you see
Yes.
inflation ending the year?
That's a tough one, Jeremy, because I think the US is going to a recession. But I think the
Will
Chinese
that will
manufactured
that
product
will that accompany will a deflationary event accompany the recession?
looks like it looks like it's going to be stagflationary because I think with this Trump tariff and reshoring efforts, and you know Trump already slapped 20% tariffs on China on everything,
Right.
including your cheap crap plastic. That's what people call it, and treat cheap electronics, whatever, everything, 20%. So I said it in another program that the Chinese factories are going to stand their ground this time because they're not making enough money as it is. Like a lot of these companies in China they are already only making 10% gross margin when dealing with American companies. So there's no more cost cutting that they can do to account for the 20% tariffs. That means once the big box retailers in the US run through their inventory by the end of 2025, they might have to jack up prices. And I'm saying this very conservatively, as you can tell, right? So if that happens, I can see US inflation going up, but you have that oil going down. So I think Donald Trump, the best into they're really juggling everything. They're trying to juggle everything so that maybe overall inflation won't go up, but you get into a stagflationary situation
Okay, so if we're
for the meanwhile. Yeah.
so would you say that you would expect inflation to remain around 3% like it is now? Do you think it'll be in a range 3 to 4, 4 to 5? Could you put a number on it?
Possible that they might be able to keep inflation actually within range. Why do I say that? Because US inflation, a lot of it is based on rental
Yeah,
income. A lot of the core inflation, they don't count, like food. They don't count that.
right.
So as a result, and I know they don't count the consumer electronics plastic wrap from China. So as a result, at the end of the day, they might actually be able to keep inflation within range using their metric, okay, using their metric, not
Right.
real life inflation. So I think by the end of the year, some stuff in the US will inflate and some stuff will deflate. I mean, if Donald Trump and his team all of a sudden tells everybody to dig for oil, pump oil in the US, how is oil prices going to go up? That's why I gave oil prices only 70,
Yeah.
right? So some stuff will go down, some stuff will go up, and like I said, it's probably going to be a stagflationary situation in the short term.
Okay. Well, Eric,
Yeah,
always love chatting with you. Thank you for coming on to Metals and Miners, for being so generous with your time, analysis, and ideas. Would you just share with everybody where they could find you to read about your daily postings on the gold and silver markets and what's taking place, the updates, etc.?
yes, my X account is at King Kong 9888. And you can find everything that I post and write right there.
Okay, perfect. And Eric, of course, I'll have you back on soon. I always enjoy talking with you. You share great information. Everyone loves listening to you and loves to hear your updates. So we'll reconnect soon. And thanks for being here with us today. And everybody else, thank you for watching.
Thank you, Gary.
Well, hey, everyone, welcome to this fantastic interview with Eric Young, precious metals expert. This has been an amazing discussion. And before we wrap up here, we ask our final set of questions for Eric. I just want to direct everyone interested in the metals and mining sector and investments just to dive into our Substack at metalsandminers.substack.com. Join the community, receive a free report titled "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio.